Stocks to buy in February 2021. Generally, the stock exchange has delivered excellent supply to investors over the years, but stock markets go down, presenting investors with the chance for both gains and reduction, for return and risk. As the market develops, so do business earnings. That is because economic expansion creates jobs, which generates income, which generates revenues. The fatter the paycheck, the more significant to boost the customer demand, which drives greater earnings into businesses' cash registers. It will help understand the stages of this company's cycle growth, summit, contraction, and trough. Stocks have averaged an annualized yield of 10%. That is far better than the average annualized inflation rate. It means you have to get a longer period. This way, you can purchase even when the value temporarily falls. The stock exchange makes it effortless to get shares of companies. You can buy them via a broker, a financial planner, or even online. As soon as you've set up an account, then you can purchase stock in moments. Some online brokers like Robinhood allows you to buy and sell shares commission-free. Most investors wish to purchase the stock at a low price and sell it high. They invest in fast-growing businesses that appreciate value. That is appealing today to dealers and investors. The very first group expects to make the most of short-term tendencies, although others hope to observe the organization's earnings and stock price increase over time. They believe their stock-picking skills let them outperform the industry. Other investors would rather have an average flow of money. Those businesses grow at a reasonable speed. The financial exchange permits you to sell your stock whenever. Market analysts utilize the expression fluid to mean you can transform your offers into money rapidly and with low exchange costs. That is significant if you out of nowhere need your cash in a rush. Since prices are unstable, you risk being compelled to assume a misfortune. So, with such premises, stock market has made earnings very easy for the everyday man. We have brought two stocks for you today for February 2021 that have great potential and increase their value as the clock ticks. We are starting with the first one. HIMSS, Healthcare Information and Management System Society, Inc. HIMSS is a worldwide advisor and thought leader behind transforming their health ecosystem through technology and information. As a mission-driven nonprofit, HIMSS provides an exceptional depth and breadth of experience in health innovation, public policy, workforce development, analytics, and research to notify international leaders, stakeholders, and influencers on best practices in health information and technology. During our creation engine, HIMSS delivers crucial insights, engaging and education events to healthcare providers, authorities, and marketplace providers, ensuring that they have excellent advice at the point of conclusion. Headquartered in Chicago, Illinois, HIMSS functions with the international health advice and technology communities, using concentrated operations across North America, Europe, the UK, the Middle East, and the Asia Pacific. Our members include over 100,000 people, 480 provider associations, 470 nonprofit partners, and 650 healthcare organizations. Talking of its stock exchange market value, it has enormous potential. It will go up shortly, and it has an excellent exchange rate for both trading and long-term investments. Second, HIMSS has an edge in its concentrate on the millennial marketplace. Unexpectedly, HIMSS and HERS see possible building up its market share within this still young market, with the earliest millennials turning 40 this year and the youngest is 25 years of age. True, this is not the sole telehealth inventory on the market. In reality, more established players hold a substantial market share within this area. However, while it is an early-stage firm, HIMSS and HERS includes an excellent pathway to be a pioneer in this fast-growing business. So, using its high growth in your mind, purchasing HIMSS stock today, even at the wealthy evaluation, resembles a rewarding risk-return proposal. How so? Firstly, though it was just begun in 2017, the firm already supplies a vast array of telehealth services. starting by providing solutions tailored to men's wellness demands. Thus, the Hims manufacturer, the business quickly expanded to providing health and wellness options for ladies. But that is not all. Additionally, the organization also supplies a massive array of other healthcare products and solutions. Last, the business is growing at a quick clip. But in just a year, it hit $27 million in earnings, and that is only the beginning. In my view, the business is wise to pursue this particular market. As millennials advance in age, they are not likely to be happy with the old-school health version. Thus, Hims can catch the industry today and hold on to it for the forthcoming decades. Nonetheless, this is only one situation you do not want to miss out on by missing the woods for the trees. That's to say, relative to present principles, Hims & Hers looks entirely priced, given its high indicated price-to-sales ratio, and also the truth it's yet to achieve adulthood. However, taking a peek at future expansion, the inventory at the current prices may end up becoming a steal. One variable that may involve some investors skittish about Hims' inventory is that rich valuation. After its own SPAC merger, the provider is worth $1.6 billion. That is large relative to the current level of earnings. Unlike some other lately closed SPAC mergers, investors are not overly excited about this chance. However, don't overlook telehealth as still another megatrend place to perform in the upcoming decade. According to projections provided within a current investor presentation, the business sees its high line rising in the next few years, and I would not assume expansion is put to stall after that. In a nutshell, benefit from the current pullback. Purchase Hims inventory. Put it all together, and it is clear that this is not an expansion story to jump out because of valuation concerns. Splitting hairs today can lead to sorrow down the street. Smartly moving after the millennial economy, with a few of those prospective clients about the cusp of the 40s, the organization's runway is extensive. Yes, its valuation might appear high now. But considering this particular name's tremendous development prospects, the superior is more than worthwhile. And with this plan to expand to other telehealth favorable markets, global expansion is about the dining table, too. Second to our list is Corsair. Corsair, or CRSR, is a computer hardware company. Besides the headquarters in Fremont, California, Corsair keeps a manufacturing facility in Taoyuan City, Taiwan, for construction, evaluation, and packaging of PIC products, distribution facility in Asia, the USA, and Europe, and has sales and marketing offices across the USA, as well as many Asian and European nations. The business trades under the ticker symbol CRSR were recorded in the NASDAQ stock market throughout the COVID-19 pandemic, which resulted in lockdown orders that led to a substantial growth in Corsair's earnings. Corsair Gaming Inc., commonly known as Corsair, is an American PC peripheral and hardware firm headquartered in Fremont, California. The organization, known formerly as Corsair Components and Corsair Memory, was first incorporated in California in January 1994 as Corsair Microsystems and was reincorporated in Delaware in 2007. Corsair designs and sells a range of products for computers such as high-speed DRAM modules. ATX Power provides PSUs, USB flash drives, UFDs, CPU, GPU, and case cooling system, gambling peripherals, for example, keyboards and PC mouse, PC cases, solid-state drives, SSDs, along with speakers. CRSR has excellent potential in the stock market too. It has continuously risen over time. The financial health and growth prospects of CRSR demonstrates its potential to underperform the market. It currently has a growth score of D grade. Recent price changes and earnings estimate revisions indicate this would be a good stock for momentum investors with a score of A. That's because Corsair is visiting positive earnings estimate revision actively as of late, which is usually a precursor to a sales beat. After all, Analysts increasing quotes before earnings, together with the latest up-to-date advice potential, is a relatively good indicator of several positive tendencies underneath the surface to CRSR within this report. In reality, the most precise estimate for the current quarter is presently 54 cents per share for CRSR compared to some broader Zacks consensus estimates of 47 cents per share. This implies that analysts have lately awakened their quotes CRSR, giving the stock a Zacks earning ESP of plus 14.29% heading into earnings. Investors are always looking for stocks poised to conquer at the earnings period, and Corsair Gambling Inc., the company, has earnings coming up reasonably soon, and events are shaping up very well for their report. Given that CRSR includes a Zacks rank number 2 and an ESP in the positive field, you can view the whole list of the Zacks number 1 rank strong buy shares here. Indeed, recent earnings estimate revisions imply that great things are ahead for Corsair, which may be in the cards to the upcoming report. A positive reading to your Zacks earnings ESP has turned out to be quite successful in generating positive surprises and outperforming the market. Our current 10-year backtest proves that stocks with a positive revenue ESP plus a Zacks rank number 3 hold, or even better, reveal a positive surprise almost 70% of their time and have returned 28% on average in annual yields. Thus, CRSR is another excellent option for my money-making family. Hope you all enjoyed the video. Make sure that you subscribe to our channel and press the bell icon so that you never miss any video when we upload one. Like this video if it was informative and helpful for you, and let us know in the comment section which one of the two you liked the most. See you next time.